All right, let's just dive right into this. 1,044.21%. That is the staggering 10-year total return for the asset we are examining today. Now, when you see a number like that, it is so easy to get blinded by the sheer magnitude of the gains. But as focused learners, we want to know exactly why it happened. We're going to pop the hood on this absolute luxury vehicle of a stock to see exactly how its internal machinery produces that kind of horsepower.
Welcome to this explainer. Today, our mission is to completely dissect the underlying financial engine of Rambus, ticker symbol RMBS. We're talking about a $15.4 billion semiconductor and tech asset. And we aren't just going to look at a stock chart and guess where it's headed. No, we are diving into the raw data, the margins, the balance sheet, and the valuation to really understand the anatomy of what appears to be a veritable cash machine.
So here is our systematic 5-step inspection for today. We'll start with the spectacular stock performance, move to unpacking the growth engine, verify the bulletproof balance sheet, brace ourselves for paying the premium price, and finally, calculate the final fair value.
Step 1. Spectacular stock performance, the flashy exterior. Rambus commands a massive $15.4 billion market cap, but what's truly explosive here is its recent short-term momentum. The year-to-date return sits at a phenomenal 53.78%, and in just the last 30 days alone, it generated a 77.24% return. If we zoom out to the trailing 12 months, it's up 170.61%. The data literally shows this asset has rallied over 200% from its 52-week low. I mean, that is just incredible momentum.
And looking at the historical context laid out over the last decade, you're looking at a veritable sea of green. You have these massive breakout years like 2023, boasting a 90.54% return, and 2019 at nearly 80%. But it also brilliantly illustrates that even the luxury assets hit occasional potholes, right? Look at 2018, down 46%, or 2024, down over 22%. So it's a high-performance vehicle, but it definitely isn't immune to market gravity. The overarching trend, though, is aggressive upward momentum.
Let's move to step 2, unpacking the growth engine, fuel and efficiency.
Looking at the revenue compound annual growth rate, the absolutely crucial point isn't just that Rambus is growing, it's how it's growing. Notice the trend? The 3-year growth rate is 15.86%. The 5-year rate is 23.13%. But the trailing 12 months growth has accelerated up to an impressive 27.13%, pushing total revenue to over $707 million. This engine isn't just humming along, it's actively speeding up.
But hey, revenue means absolutely nothing if a company can't keep it. The true fuel efficiency of Rambus is incredibly clear when you look at its gross profit margin, 80.08%. That means for every single dollar Rambus earns, it only costs them about 20 cents to physically deliver their product or service. The other 80 cents? That's pure gross profit kept within the company. In the semiconductor space, having that kind of pricing power is absolutely elite.
Now, of course, gross profit doesn't account for running the corporate office, paying for research and development, or covering taxes. But even after we subtract all of those operational expenses, look at the final bottom line. A 33.66% net profit margin. To put that into perspective, out of every dollar that comes through the door, over a third of it drops straight into their pocket as pure, unadulterated profit. That is an incredibly efficient cash-generating machine.
And this right here is where we see the real skill of the management team, 30.33%. This is their return on invested capital, or ROIC. This translates to a very simple but incredibly powerful concept. For every single dollar Rambus reinvests back into its own business, it generates an exceptional 30 cents in return. Think about it. If you had a bank account that gave you a guaranteed 30% yield every time you deposited a dollar, you'd put every dime you had into it. Well, that is essentially the financial engine Rambus is currently operating.
Step 3. The bulletproof balance sheet, armor and safety features.
That giant zero represents their debt-to-equity ratio. It is exactly 0. They have zero financial drag holding them back. In an economic environment where fluctuating interest rates and borrowing costs have completely crippled other tech firms, Rambus owes absolutely nothing relative to its equity. They're entirely self-funded by their own massive cash flows.
And their liquidity, which is their ability to pay off any short-term obligations, is just as strong. The current ratio measures a company's short-term assets against its short-term liabilities. Now, anything over a 1.0 is generally considered safe. Rambus's historical 3-year average was already a stellar 7.68, but look at the current trailing 12 months. It has expanded to 820. They're actively expanding their short-term liquidity and safety buffer. This balance sheet is literally built like a tank.
Step 4. Paying the premium price. The sticker shock.
Stacking these valuation multiples together reveals just how expensive this stock is compared to traditional value metrics. We've got a price-to-earnings ratio of nearly 67, a price-to-sales ratio of almost 22, meaning investors are paying $22 for every single dollar of sales a company makes, a price-to-book ratio of over 11, and an enterprise value to EBITDA of 48. By almost every single traditional value investing standard, these numbers look incredibly stretched.
And what's absolutely crucial to understand here is that Rambus isn't just expensive in a vacuum, it's expensive relative to its own history. Its current PE ratio of 66.97 is trading at a massive, almost 67% premium to its own historical 5-year average. The market isn't just pricing in past success, they are paying a massive premium for future perfection.
Which brings us to step 5, the final fair value. Is it worth it?
So the ultimate question for you, is the premium price actually fair? Given the flawless balance sheet and those incredible 80% gross margins, does the math actually support paying nearly 67 times earnings?
Well, let's look at what the discounted cash flow models tell us. Now, the DCF model projects all the future free cash flow a company will generate and discounts it back to today's dollars. The last close price for Rambus was $141.31. But according to the free cash flow model in the data, the calculated fair value price is actually $151.92. Surprisingly, despite all those sky-high valuation multiples we just talked about, the math says the stock is actually undervalued right now based on the sheer volume of cash it's projected to generate.
And that leaves us with this final number, 6.98%. That is your margin of safety. It's the gap between the current trading price and its intrinsic fair value. Look, the company is fundamentally a powerhouse, right? Zero debt, massive margins, accelerating revenue. But I want to leave you with this final, somewhat provocative thought based on the data. When you are paying a massive historical premium for an asset, is a roughly 7% margin of safety a wide enough buffer for your own portfolio? Or does it leave too little room for error if this cash machine ever stalls? Something for us all to think about.